Karooooo Limited just dropped their Q1 2027 earnings report, so let's get straight to the numbers for the quarter ended May 31st, 2026. Top line, annualized recurring revenue hit 5.43 billion rand, which translates to roughly 335 million US dollars. Operating profit came in at a record 410 million rand. Management reaffirmed their full year 2027 EPS growth guidance at 21% at the midpoint, and they declared a $1.50 US dollar interim dividend. The market reaction right now has been digesting this really fascinating mix of massive subscriber acceleration weighed against a pretty significant drop in free cash flow.
Right, yeah, it's a very specific kind of earnings print to digest.
Exactly. So our mission for this deep dive today is to look at Karooooo. They are the parent company behind Cartrack and Karooooo Logistics, and really figure out how an operational intelligence platform sustains this kind of massive growth and, what the financials actually reveal about their underlying machinery. Because if you're an investor or even just someone fascinated by how IoT is running the global supply chain, there is a lot here.
There really is. And I mean, to deconstruct this effectively, we have to look closely at the raw data they actually process. We are looking at a platform acting as the central nervous system for a company's physical operations.
Central nervous system.
Yeah, exactly. We're talking vehicles, physical assets, and the human workforce, all connected into one intelligent ecosystem. It is not just about, placing a dot on a map anymore. It is about ingesting billions of data points regarding safety, compliance, route efficiency, and then translating all that into actionable operational leverage for their clients.
Which is huge. And the scale of that data ingestion is really the first thing that jumps off the page when you look at this report. Cartrack's subscriber base grew by 18%.
Pushing them past 2.8 million subscribers globally.
2.8 million. But the real story for me is the net additions.
Yeah.
They added 142,472 net new subscribers in a single quarter. I mean, that's a 70% increase year over year.
The acceleration is the anomaly here. I mean, in subscription software, the law of large numbers dictates that as your baseline user count gets bigger, the percentage growth rate naturally shrinks. You eventually saturate the early adopters.
Yeah, the math just gets harder.
Exactly. But net additions in their primary market, which is South Africa, jumped 92%.
92%.
Yeah. At a maturity level of 2.8 million subscribers, achieving that kind of acceleration indicates the product has really transitioned. It's moved from a discretionary tracking tool to absolute mission-critical infrastructure for these fleets.
Well, let's talk about what makes it mission-critical, because I think that explains why the subscription revenue is up 19% to 1.35 billion rand. If you're a fleet manager, say, operating 1,000 delivery trucks, the margins in logistics are incredibly thin.
Razor thin.
Right. So if this software is pulling telematics on engine idling, optimizing delivery routes to cut fuel consumption by 10%, and using AI video to monitor driver fatigue to prevent accidents, it pays for itself almost immediately.
Well, without a doubt.
Once a company integrates that level of cost control into their daily workflow, churning out of the subscription isn't really an option. It would be like turning off the lights in the warehouse.
Which is a great point, and it brings us to a really vital dynamic on the income statement this quarter. Because you would normally expect that kind of product stickiness and top-line acceleration to immediately expand the operating profit margin.
Yeah, the operating leverage should kick in.
Right. However, the operating profit margin actually contracted slightly this quarter. It moved from 30% down to 28%.
Down to 28, yeah, I noticed that.
Yeah.
And look, if the product is so sticky, why are margins shrinking? My immediate skepticism as an analyst is always that they are just buying this top-line growth.
Sure.
It is very common to see software companies brag about record user acquisition. But then you look under the hood, and they are offering massive discounts or heavily bloating their marketing spend just to acquire users who will eventually churn. I want to know if this 142,000 subscriber bump is actually trickling down to the bottom line, or if the cost to acquire them is just destroying the unit economics.
That's $1 million question, right? And we can answer that by looking directly at their sales and marketing expenses, which increased by 32% to 239 million rand.
Okay, so that's a big jump.
It is. They're aggressively building distribution capacity and hiring sales staff. But the margin contraction is actually a direct result of accounting standards, specifically IFRS rules.
The immediate expensing.
Exactly. Customer acquisition costs. So the sales commissions, the marketing campaigns, those must be expensed immediately on the income statement the exact moment they are incurred.
Right, so this is the classic SaaS timing mismatch.
Yes, 100%.
They take a total 100% financial hit on day one just to acquire the customer. But the revenue from that customer doesn't arrive on day one. It is recognized monthly over the life of the contract.
And the report specifically notes their expected contract life cycle exceeds 60 months.
60 months, wow. So they are absorbing all the pain on today's income statement to secure revenue that will drip in over the next 5+ years.
That's the structural timing mismatch perfectly explained. To visualize the mechanics of this, you just have to consider the unit economics, specifically the ratio of customer lifetime value to customer acquisition cost, the LTV to CAC.
Right.
Karooooo's LTV to CAC ratio currently exceeds 9x.
Let me just pause you on that for a second because 9x is wild.
It is basically unheard of.
Yeah, I mean, a 3x or 4x ratio is generally considered the gold standard benchmark for a healthy software business. At 9x, you're saying for every dollar they spend acquiring a customer today, they generate $9 in gross margin value over that customer's lifespan.
Exactly. The 9x ratio provides just a massive margin of safety. It proves the margin contraction isn't from inefficiency or bloat. It is a deliberate capital allocation strategy.
Right.
If you possess a mechanism that yields a 9x return, the rational management decision is to pour as much capital into that mechanism as possible, even if it temporarily compresses the operating margin from 30% down to 28%.
Because the operating leverage will materialize in future quarters when the upfront acquisition costs are fully amortized, and then those subscribers become pure margin.
Exactly.
You know, it's essentially like planting an apple orchard.
Oh, I like that analogy.
Yeah, think about it. You have to buy the land, the seeds, the fertilizer, and pay for the heavy machinery and labor all up front. If you evaluate the business on the exact day you plant the seeds, the margins look terrible, the expenses are massive, and there is zero revenue.
Right, you're just bleeding cash on paper.
Exactly. But because you planted those trees, you get to harvest and sell the apples for the next 5 years with minimal incremental cost. Karooooo's just planting a massive orchard right now.
They absolutely are. And the core CarTrack subscription engine is functioning exactly as that orchard model suggests. But we also need to examine how they are leveraging this underlying infrastructure beyond just basic fleet tracking.
You mean the logistics side?
Yeah, the report highlights the Karooooo logistics segment, which operates a B2B delivery as a service model.
Goes.
Right. Revenue in this segment surged 46% to 177 million rand, and gross profit margins improved to 32%.
Which is really strong. The demand there seems to be totally driven by quick commerce. We are seeing these enterprise clients who need to fulfill ultra-fast, on-demand deliveries to compete, but building a proprietary physical delivery fleet is incredibly capital-intensive.
Oh, it's a nightmare for the balance sheet.
Right. Buying hundreds of vans and hiring full-time drivers in a high-interest rate environment is a massive risk. So instead of taking on that physical asset risk, an enterprise can just integrate with KARO Logistics via an API.
Exactly. This connects the enterprise directly to an elastic network of third-party delivery drivers. It allows a large retailer, for example, to scale their delivery capacity way up during peak holiday seasons and then immediately scale it down when demand drops, completely without holding the physical assets.
It is basically the Amazon Web Services model, but for physical delivery.
That's a great way to put it.
It's elastic compute translated to elastic logistics. They don't own the trucks. They just provide the routing algorithms and the intelligence network to orchestrate the movement.
Right. It is a highly scalable, capital-light revenue stream built right on top of their core competency in tracking and routing.
Makes total sense. Okay, so shifting gears a bit to where this growth is geographically concentrated, because that reveals another layer of complexity in this report. South Africa obviously remains the anchor of the business.
Yeah, they have over 2.1 million subscribers there, with subscription revenue growing at 24%. It's a wildly dominant market position.
But the international segments are scaling rapidly too. Asia Pacific and the Middle East surpassed 350,000 subscribers, and that's growing at 22%. Europe is up 13% to over 236,000 subscribers.
The subscriber growth is clear, yeah.
Right, the international growth is super clear on the subscriber side.
Yeah.
But when you look at the reported revenue for those regions, it looks a lot softer. And the report specifically points to foreign exchange headwinds here.
Yeah, the FX translation.
Exactly.
Yeah.
For anyone analyzing global SaaS businesses, currency translation is just a crucial mechanism you have to understand. KAROOoo operates in over 20 countries, collecting revenue in euros, Singapore dollars, and various other currencies. but they consolidate all their financial statements in South African rand.
And the mechanics of that translation can heavily distort the operational reality you see on the page.
Right.
If the South African rand strengthens against the euro, meaning 1 rand buys more euros this quarter than it did a year ago, the exact same revenue collected in Europe translates into fewer rand on the consolidated income statement.
So a fleet manager in Singapore is still paying the exact same monthly subscription fee in Singapore dollars.
Yes.
The business there hasn't lost any pricing power or volume or anything, but purely because of the exchange rate shift, Karooooo has to report a lower revenue figure in their home currency.
Precisely. And to cut through that distortion, the report provides a constant currency metric. This strips out the exchange rate fluctuations, essentially assuming the currency values remained perfectly flat year over year.
Right, to see the real growth.
Exactly. In the Asia-Pacific and Middle East region, reported subscription revenue only grew 6%.
Which sounds terrible.
Right, but on a constant currency basis, it actually grew 17%.
Wow.
The actual volume of business and product adoption is expanding near 20%, but the strength of the Zanyur completely masks the underlying operational success.
It really highlights why you can never just read the headline revenue number of a multinational company without looking at the currency impact. Because in this case, the underlying demand is clearly accelerating. But, and this is big, but if the business is accelerating and unit economics are throwing off a 9x return, we have to address the cash flow statement. Because free cash flow just dropped off a cliff this quarter.
It did.
It fell from 338 million rand a year ago down to just 60 million rand this quarter.
Yeah.
Operating margin is one thing, but you cannot pay employees or fund expansion without cold, hard cash. So where did it all go?
Well, the cash flow statement is where the realities of software really intersect with the physical world of the Internet of Things. Karooooo is not just provisioning a cloud login. To integrate a commercial truck into that central nervous system we discussed earlier, they have to deploy physical hardware.
The sensory receptors,
Exactly.
the actual car track telematics tags, the AI-powered video cameras, the engine diagnostics sensors. The software brain is basically useless without the physical hardware collecting the data from the cab of the truck.
Spot on. And the drop in free cash flow is the direct result of financing those 142,472 net new subscribers.
All right.
You have to manufacture, purchase, ship, and physically install hardware into 142,000 vehicles. The financial statements show a massive 462 million rand investment in in-vehicle IoT devices this quarter alone.
That's a huge outlay.
It is. They are utilizing the cash generated by the existing subscriber base to purchase the hardware required for the incoming wave of customers, while also stockpiling inventory just to ensure supply chain resilience for future quarters.
Okay, so the cash didn't just vanish into inefficient operations. It was literally transformed into physical assets on the balance sheet.
Exactly.
They are funding the apple orchard purely through internally generated cash. And even after that massive 462 million rand capital outlay, their balance sheet remains incredibly liquid. I mean, they are holding 755 million rand in net cash.
And the composition of that cash pile is very strategic, too. In line with their capital allocation policy, they hold those excess reserves primarily in U.S. dollars.
Which acts as a natural hedge against the exact foreign exchange headwinds we were just discussing.
Right, exactly.
Because if you operate in emerging markets, holding your surplus cash in USD protects your purchasing power when you need to buy semiconductor components or hardware from international suppliers.
It's very defensive.
Yeah. I also noted their debtor collection period is sitting at 31 days.
Which is excellent. A 31-day collection cycle in the B2B sector indicates really robust working capital management. Their clients are paying their invoices on time, which immediately cycles back into purchasing more hardware for the next deployment.
The flywheel is spinning.
Yes. When you combine strong unit economics, a liquid USD cash position, and a tight cash conversion cycle, it just gives management extremely high visibility into their future liquidity.
And that visibility is super clearly reflected in their capital return policy. Declaring a $1.50 US dollar interim dividend while simultaneously deploying nearly R500 million into physical hardware is a massive signal of confidence.
You don't distribute that kind of capital to shareholders unless you're absolutely certain the core engine will continue generating excess cash.
Right. So the broader takeaway from this quarter really feels like a masterclass in self-funding. They are leveraging the cash flow from their dominant high-margin South African base to finance an aggressive global hardware deployment, capturing international market share and absorbing FX headwinds entirely without needing to raise dilutive external capital.
It's a very clean growth story, yeah.
Mhm.
But there is a detail buried in the geographic breakdown that points toward a massive structural shift in how this business might look, say, 5 years from now.
Oh, really?
Yeah. We talked about how capital intensive it is to buy and install all these aftermarket IoT devices,
Was
right?
the 462 million rand hit.
Exactly. But the report specifically mentions their European subscriber growth is being actively supported by strategic partnerships with leading OEMs, the original equipment manufacturers. We are talking about the Fords, the Volvos, the companies physically building the commercial trucks on the assembly line.
Wait, so they are partnering directly with the truck manufacturers?
Yes. Those partnerships allow Karooooo to integrate connected vehicle data directly into their platform via APIs. This completely bypasses the need for a physical car track technician to install an aftermarket tag in the vehicle.
Oh, wow. Okay, so if the commercial truck rolls off the factory assembly line as a fully internet-enabled machine, with
Mhm.
built-in sensors and factory-installed cab cameras, the entire aftermarket hardware industry faces an existential question.
Exactly.
If the truck already has the sensory receptors built in, Karooooo doesn't need to spend 462 million rand a quarter on IoT hardware. They literally just turn on the software integration.
And the implications for their financial profile there are profound. If the industry shifts and Karooooo evolves from a hardware and software provider into a pure data, AI, and operating system layer integrated at the factory
The
level.
capital intensity just drops to near zero.
Exactly. The free cash flow dynamics and the margin profile we analyzed today would fundamentally transform. It would be a pure software margin profile.
It sets up an incredible race for the industry. Because as every physical asset in the global supply chain becomes born connected, the big question is, who will ultimately own the operating system that makes sense of all that data?
It's a massive addressable
It
market.
really is. It's definitely something we will be watching closely as these OEM partnerships scale in Europe and globally. For you listening, make sure to follow the show for our daily earnings coverage as we continue to track the financial architecture of the global supply chain. Catch you on the next deep dive.